A billionaire and a nurse walk into tax season. The nurse earned $72,000 last year, working night shifts, weekends, and double overtime through flu season. The billionaire made $94 million, mostly without getting out of bed. Now here is the part that should not be possible. The nurse pays a higher tax rate than the billionaire. Not a higher dollar amount, a higher rate, a bigger slice of every dollar she earns. And here's the twist that most people never hear. It is not illegal. It's not even a loophole in the way you imagine loopholes. It's the tax code working exactly as written. And that's the part nobody explains. So in this video, I am going to explain it. 7 strategies rich people use to legally pay less tax than you. And by the end, you will know exactly which of the 7 you can run this year, and roughly how many dollars each one is worth to you. Before we start, one thing needs to be said plainly. Nothing in this video is tax evasion. Tax evasion is hiding income and sends people to prison. Everything you are about to hear is written into the tax code on purpose by Congress, often with a press release attached. Some of these strategies are available to you today, this year, with the paycheck you already have. Some of them genuinely are not, no matter what some guy on the internet selling a course tells you. I'll be honest with you about which is which, because pretending you can do what a billionaire does is how people end up audited, broke, or both. Now, before way number 1, you need the one rule that makes all 7 make sense. Here it is. Wages are taxed hardest. Ownership is taxed lightest. That's it. That is the entire secret. The tax code punishes money you earn with your time and rewards money your assets earn while you sleep. Rich people did not find a cheat code. They simply arranged their lives so that income arrives as ownership instead of wages. Everything in this video is that one sentence wearing 7 different costumes. Watch for it. Way number 1. Capital gains rates instead of wage rates. Meet Sarah, a project manager earning $110,000 a year. Her top dollars get taxed at 24% federally, plus 7.65% in payroll taxes, plus state tax. Call it 35 cents lost from every marginal dollar. Now meet Robert, who does not work at all. Robert sold stock he had held for 2 years and collected the same $110,000. His rate on most of that money is 15%, 0 payroll tax. And if Robert had kept his total income under about $48,000, his long-term capital gains rate would have been 0. Not low, 0. The brackets in 2026 run 0, 15, and 20%. And even the top capital gains rate of 20% is lower than the wage rate a good dentist pays. Run the one rule on it. Sarah earned wages, taxed hardest. Robert collected ownership income, taxed lightest. The catch, and I'll always give you the catch, is that you need assets to sell, and the gain must be long-term, meaning you held it over 1 year. Sell at 11 months instead of 13, and the government treats you like a wage earner again. The verdict? You can run this today. Every share you buy in a normal brokerage account and hold past 1 year converts future income from wage rates to ownership rates. Most channels stop there and call it a day. But what if you never sold the stock at all? What if you could spend the money without ever triggering the tax? That sounds impossible, and it is. Way number 2. Way number 2. Buy, borrow, die. This is the famous one, the strategy behind every headline about billionaires paying almost nothing. Here is the whole thing in 3 moves. Buy assets that grow. Never sell them because unsold gains are not taxed. Instead, borrow against them because loans are not income. So a billionaire with $2 billion in stock can borrow $20 million a year at a low rate and legally report almost no taxable income. Then, die. And here's the astonishing part. When his heirs inherit the stock, the tax basis resets to the current value, and all those decades of gains simply evaporate for tax purposes. The gain is never taxed, not deferred, erased. Run the one rule. He never converted ownership into wages or even into a sale, so the tax never had a trigger to fire. Now the honesty beat. This one is not for you yet. Banks do not extend cheap portfolio loans against a $40,000 index fund, and if the market crashes, the loan gets called and the whole structure collapses. But hold on to this idea of never selling and letting death erase the gain, because a smaller, completely legal version of it comes back at the end of this video, and it is one almost nobody uses. For now, remember the phrase, "The gain that is never realized is never taxed." That phrase pays off later. Way number 3, tax loss harvesting. This is the strategy that sounds fancy and is actually just organized honesty about your losers. Say you own 2 index funds. One is up $8,000, one is down $5,000. A normal investor ignores the loser and feels bad about it. A rich investor sells the loser, immediately buys a similar but not identical fund so they stay invested, and books a $5,000 loss on paper. That loss cancels $5,000 of gains elsewhere, and if losses exceed gains, up to $3,000 per year comes straight off ordinary income. For someone in the 24% bracket, that $3,000 deduction is $720 of real cash every single year for doing nothing except acknowledging reality. Wealthy families run this automatically, with software scanning their portfolios daily. Ask yourself, why would the tax code reward you for selling losers? Because Congress decided investment risk deserves a cushion. Ownership protected again. Wages get no such cushion. Ever tried deducting a bad year at work? The catch is the wash sale rule. Buy back the identical security within 30 days and the loss is disallowed. So you must buy something similar, not the same. The verdict? You can run this today, this literal week, if you hold any losing position in a taxable account. $720 a year, compounding, for a trade that takes 4 minutes. But harvesting losses only shields money that is already invested. What about the paycheck itself? Can you shield wages before the government even touches them? That is way number 4, and it's the single biggest one for normal people. Way number 4, retirement account stacking. Not just a 401k, the full stack. Here is Marcus, a nurse anesthetist earning $180,000. First layer, he puts $24,500 into his 401k, which in his 32% combined bracket saves him about $7,800 in tax this year. Second layer, he earns too much for a normal Roth IRA, so he uses the Backdoor Roth, contributing $7,500 to a traditional IRA and converting it to Roth days later, completely legally, a route Congress has known about for 2 decades and left open. Third layer, and this is the one most people sleep on, the HSA, the Health Savings Account, around $4,400 for a single person in 2026, and it is the only account in America with a triple tax advantage. The money goes in untaxed, grows untaxed, and comes out untaxed for medical costs. No other account gets all 3, not one. Stack all 3 layers, and Marcus shelters over $36,000 in a single year and saves roughly $10,000 in tax. Run the one rule. Every dollar in these accounts stops being a wage the moment it crosses the line and becomes ownership, growing in a protected wrapper. The catch is real though. This money is locked. Touch the 401k early and you pay the tax plus a 10% penalty, so this is not an emergency fund. The verdict? You can run this today, and honestly, if you skip everything else in this video and only do this, you are ahead of 90% of the country. Now, most finance channels would end the list here because the next 3 are where it gets uncomfortable. They require owning things most viewers do not own yet. I am covering them anyway, because you need to see where the road goes. Way number 5, real estate depreciation. The magic trick where a building makes you money and loses you money at the same time. Meet Dana, who buys a rental house for $300,000. The tenants pay her $18,000 a year in rent. real profit, real cash in her bank. But the tax code says the building itself, about $240,000 of the price, is wearing out over 27 and a half years, so Dana deducts roughly $8,700 every year as depreciation, a paper loss on an asset that is probably going up in value. On her tax return, most of her rental profit vanishes. Her house is appreciating in the real world and depreciating on paper, and both are legal at the same time. Serious real estate investors go further with cost segregation studies that front-load those deductions, sometimes wiping out years of rental income at once. Run the one rule. Rent is ownership income, and Congress padded it with a deduction wage earners could never dream of. Nobody lets you depreciate your own labor. The catch comes in two parts. First, being a landlord is a part-time job with clogged toilets. Second, depreciation is recaptured, meaning when you sell, the government claws some of it back at up to 25%, unless, and here is a whisper of way number 2, you never sell. The verdict? This one is not for you yet if you were still renting or barely covering your own mortgage, but the small version is coming for you sooner than you think, because the same rules apply to a modest duplex where you live in one half, and that is a real first move ordinary people make every day. Way number 6, business owner deductions and the s-corp split. This is where the rich versus you gap gets loud. When you earn a wage, you are taxed first and spend what is left. When you own a business, you spend first and are taxed on what is left. Read that again because it is the entire difference. The laptop, the phone, part of the home office, the mileage, the software, the conference in a city you wanted to visit anyway, all paid with money that never gets taxed. Then comes the s-corp move. Say Priya runs a design business earning $140,000 in profit. As a sole proprietor, nearly all of it faces the 15.3% self-employment tax, so she elects s-corp status, pays herself a reasonable salary of $70,000, and takes the other $70,000 as a distribution, which escapes that 15.3% entirely. The savings on the distribution alone can top $9,000 a year. Run the one rule one more time. Priya took the exact same income and relabeled half of it from wages to ownership, and the tax bill dropped 5 figures. Here is the catch, and it is a sharp one. The salary must be reasonable. Pay yourself $12,000 while distributing $130,000, and you are inviting an audit that you will lose. And the honest verdict? Not for you yet if you have no business income at all. But if you have any side income, even $8,000 a year of freelancing, the small version starts today, because those deductions apply the moment you have a real profit motive. So the earn as owners, deduct as owners, and depreciate as owners. What do they do with the money they give away? You already know the answer. They give it away as owners too. Way number 7, charitable strategies, specifically donor-advised funds in appreciated stock. And this is where the loop from way number 2 closes. Remember the phrase, the gain that is never realized is never taxed? Watch it work at a scale you can actually copy. Say you bought stock for $10,000 and it is now worth $30,000. If you sell it and donate the cash, you pay capital gains tax on $20,000 first, maybe $3,000 lost. But donate the stock itself directly and something beautiful happens. You deduct the full $30,000 and the $20,000 gain is never taxed, not by you, not by the charity. It vanishes exactly like the buy, borrow, die gains vanish at death, except this version is available to anyone with a brokerage account and a cause they care about. Then add the donor-advised fund. With the standard deduction sitting around $15,000 for a single filer, small yearly donations often earn you no tax benefit at all. So you bunch 5 years of giving into one deposit, take one giant deduction this year, and let the fund pay out to charities on your schedule for years. The rich do this every December. The catch, honestly, is that this only saves money you were going to give anyway. Donating $1 to save 30 cents is generosity, not arithmetic. The verdict? If you already give to your church or any charity and you own any appreciated investment, you can run this today and you are probably overpaying right now if you're giving cash. So let's make this a checklist, because 3 of the 7 are sitting there waiting for you this year. 1. Tax loss harvesting, worth around $720 a year in a taxable account. 2. The retirement stack, 401k plus Backdoor Roth plus HSA, worth $8,000 to $10,000 in tax savings at a good income. 3. Donating appreciated stock instead of cash, worth about $3,000 per $30,000 donated. Added up, in an ordinary high-saving household can keep somewhere around $12,000 to $14,000 this year that they are currently handing over voluntarily. Not billionaire tricks, your tricks. And notice what all 3 have in common. Every single one moves a dollar out of the wage column and into the ownership column. That's the one rule, working for you now instead of against you. And it works at $70,000 a year just as faithfully as it works at $70 million. Now, if you want to see your own numbers instead of my characters, I built calculators for every strategy in this video. The S-corp split, the retirement stack, the harvesting math, all preloaded in the calculator vault for channel members. There's one calculator in there I didn't mention in this video, the one that tells you the exact income level where the 0% capital gains bracket turns you into Robert from way number 1. First link in the description if you want it. Here's the whole video in one line. The poor earn money and pay tax. The rich pay tax only when they choose to. And now you know the machinery behind that sentence, which means you can copy what you can and ignore the rest, without envy and without excuses. 3 of these are yours right now. Start there. But I have to warn you about something before you go. Every strategy in this video assumed you get to keep working and choosing. Retirement is different, and there's a government program you've been paying into your entire life, thousands of dollars every year, that most people claim at the wrong time and lose over $100,000 doing it. One decision made once, unchangeable. If you don't understand Social Security, you don't understand retirement. And in the next video, I'll show you the claiming mistake that quietly costs 6 figures and the one-page rule that avoids it. Watch it before you watch anything else.